This is Trader Travis, and what I want to do is give an update on my stock market prediction video I made a few weeks back, as well as talk about how do you live off your portfolio during a bear market. But first, for those who don't know me, my name is Travis Wilkerson. I am a former U.S. investing champion for the Futures and Options division, but I go by Trader Travis online. And for the last 10 years, I've been sharing my tools and techniques with people, showing them how I achieved financial freedom in about 5 years and left corporate America when I was 34. Now, quick admin note, I don't have my usual, for those who are used to me, my usual Trader Travis gear here. I'm actually rocking family gear. My sister-in-law actually owns a company, and they sent me this shirt for Christmas. It's actually a nice shirt. So those who love supporting small businesses, especially Native American-owned business. So this is my sister-in-law, nephew, my brother-in-law. So they both belong to a Native American tribe. So they have a business here, and they send us garments and hats and things like that. So if you're interested, I'll put the link below. If you want to support a small Native American business, you can do that. I proudly recommend them, and the shirt's actually comfortable too. All right, back to the video here. So on February 18th, 2022, I recorded a video and made a market prediction. That prediction is at around minute 420 of this video right here. I'll mute this video right here, but in this video, what I was saying is that I felt predictions are just opinions. They're not facts, right? It's just guesses. Anyway, I said I felt the market will fall another 5 to 10% from where it was at on February 18th, or it would stay in a downtrend for about a month until the moving averages sort out. Both things did in fact happen. And IBD, Investors Business Daily, for those who use Investors Business Daily, it is, as of now, you can see this. I'm recording this on March 17th, 2022, but this is yesterday's newspaper article on March 16th, where they said we are in a confirmed uptrend. So let me pull this over right quick and show you. So they are saying on this day we have a confirmed uptrend. They also said we had a confirmed uptrend back here, right? But it was a false signal, and that happens sometimes. But the problem is I traded off that signal and lost some money when the market reversed. So this time I want to do what I should have done the first time. Wait for Market Club, because it's never let me down. Market Club triggered, as of, I think, today, the Dow triggered a green weekly. So we're looking for the I am looking for the S&P 500 to trigger a green weekly, and that will back up Investors Business Daily's market outlook right here. Investors Business Daily, Market Club, they're all, none of them are 100% correct, but they're correct enough to make money, right? So when I say Market Club's never let me down, Investors Business Daily has never let me down anyway, right? Because when the market reversed, they changed their stance. They're like, well, the breakout failed. We're back into a correction. We wait for another signal, and we have that. So that's what I was waiting on. Investors Business Daily, I'm waiting on the Market Club Green Weekly. I'm also waiting on this, prices to trade above 30-day moving average, because it was acting as a form of resistance, holding prices below it. So that's another thing I was looking for. I was like, I am not going to get bullish again until prices close above it and hold above this line. And now Market Club, now Investors Business Daily and potentially Market Club is also going to be in agreement with that and signal us that this correction is over and the bottom is in. So that's another way of saying it. Investors Business Daily has signaled the bottom of the correction, but nothing is guaranteed. Please keep that in mind. So what will I do from here? Well, once Market Club signals a green weekly, I will get back in a few low risk bullish trades. They're not quasi gamble trades, because the green monthly is the full signal to be full on bullish, but sometimes you can use the green weekly to get in a little early, right? And a little early in an uptrend, because the monthly will take a while to kick in. But they're riskier trades, and you have to keep in mind that you could potentially lose some money. And so that's why I start out with low risk bullish trades, and then when we get the green monthly, I'm going full on bullish and very little caution. Right? Why very little caution? Because the thing that people fear, which is the market correction, has already happened, right? There's no reason to fear anymore. That thing, that event that people fear has already happened. So I can, be more aggressive. And you're like, well, but Travis, what if it's a fake out? What if the market falls again? That's easy, right? Both Market Club and Investors Business Daily will get me right back out. So all I do is just reverse my position and get back in cash. It's not that big of a deal. I might lose a little bit of money, but I'm not going to blow out my account. And so people have to think through that. Fear is so irrational. People think, oh, I might lose a lot of money. Yeah, you will lose money if the market fakes you out, but as long as you keep your risk in check, you shouldn't blow out your account. You'll just lose a little bit of money, which is easily recoverable when the market finally bottoms and goes back up, and we can look at a 2-year chart for that. Actually, we need to go out. Gosh, we need to go out further than a 2-year chart. Let's do a 5-year chart. So we can look at the bear market of 2020 here. And generally, whether it's a bear market of 2020, bear market of 2007 or 2009, when the market bottoms out, it often rages higher. And so even if I lose money with a few fake outs along the way, the money I make when the market finally bottoms more than makes up for that. Now let me move on to the second portion of this video where I said I'm going to talk about how to live off a portfolio during a bear market, because at minute 18:20 of this, well, the public version, I've released 2 versions, a full-length 40-minute video for people on my email list, and then a 20-minute video for the YouTubers. So in this YouTube video at about minute 18:20, right about here, I was talking about my experience during the bear market of 2007, 2009. And so I talked about how do you live off your stock market portfolio during a bear market. But it was only one sentence and it wasn't a lesson. So people missed it because people kept asking me. I had at least 4 people ask me within the last week, you know, the market is down, Travis, my portfolio is down. Like, how do you handle this? Like, how do you still live off your portfolio when you're down 20, 30, maybe 100 grand? In my case, it's a lot bigger. But let me answer it again. How do you live off your portfolio during a bear market? You don't. You live off your savings or emergency fund. I said that in the video, right? But people miss it. Even when I talk about the put ladder, I'm like, hey, we use our emergency fund. Why do you think we have an emergency fund, right? But I was like, okay, I don't think I've ever done a specific lesson on that. So I just want to give a few minutes lesson on this and hopefully scare you out of trying to live off your portfolio during a bear market, because it's not smart at all, right? And I'll show you why. Let's come to Market Club Options members area here. Now, before we cover what I call a secret investing loss formula, I will say this. The best time to pull from your portfolio to live off of is when it's profitable, not when it's losing money. And we need to come to the secret investing loss formula to explain why. So let's say your portfolio lost 25%, which is very reasonable during a bear market. Actually, bear markets, you might lose 40 to 50%, but we're going to be conservative, right? I don't want to, if I use the 40% level, it will freak you out. So I'm just going to use 25% here. So if you lose 25%, your remaining balance needs a 33% gain just to get back to break even. And I'm going to use 300 grand here, and you'll see why I'm using $300,000. So if you started with $300,000, you lost 25% in a bear market, you lost $75,000, right? So what you're going to be wound up left with in your account is $225,000, right? So that $225,000 would need a 33% gain to get back to break even. So you need a bigger return just to get back to where you started. Losing money is a very unfair formula. When you lose 50%, you need a double to get back to where you started, right? So you don't want to interrupt that at all by pulling from your portfolio. Now, this is where I will share a scary lesson, and I will end with this. All right, so this is based on an example. I was talking to a trader, trying my best to convince this trader not to live off their portfolio. They did not like their job, and they were running some calculations, and they're like, well, I need X amount to live off of, and they wanted to grow their portfolio to about 100 grand. I'm like, you got to like double that, right? And so they got stuck on this 300 grand figure. And they're like, okay, if I earn 25% a year, which we can often do as option traders, it's not guaranteed, but sometimes we can do that. They're like, hey, I can produce $75,000 in income, and that's what I need to live off of. So they're targeting 300 grand. And I have been trying my best for about a year to convince this person that, no, you need a whole lot more, but they hate their job and they're ready to quit. Well, here's the challenge with this, and this is why I've been trying to convince this person not to do it. They don't have my experience. This is just best on best case scenario. So I'm going to use that same market crash prediction I just walked you through, a 25% decline. This person starts with 300 grand. They quit their job. So the 300 grand does earn some money, but when they pull money out, they're back to where they started, 300 grand. That works until it doesn't work, right? What if we have a multi-year bear market, which I talked about in the market crash prediction video? They will come. So let's say they entered a bear market and it was 1 year in length. That also happens. So if they're 300 grand, lost 25%. I just showed you that calculation, 75,000. So at the end of that bear market, they're left to 225. But no, they're not. Remember, they only plan for best case scenario. They need 75,000 to live off of. Their portfolio did not produce it that year. They don't have an emergency fund. This is all they have. So guess what? They have to pull the 75 from the 225 they have left. That's another 25% from their portfolio, or 25% based on a 300 grand starting balance. So in 1 year, they technically lost 50% of their portfolio. 25% came from the market decline. The other 25% came from the fact that they pulled from their portfolio. Now let's come back here. What did I say? When you lose 50% of your portfolio, that's how you need to view pulling money from your account. It is a loss. It's compounding backwards, compounding in reverse. It acts the same as a loss on your account. Whether you lost it because the market fell or you lost it because you pulled it out, it's still a loss. So their money needs to double just to get back to their starting amount, right? So that 150 they're left with would need to double to get back to 300 grand. But remember, they need 75,000 to live off of. So sometime at year 2, either the beginning of the year or throughout the year, they're pulling from that 150 grand account. Let's say they pulled at the beginning of the year, right? Or whenever. And let's say they struggle to make money on their remaining 150. If you pull 75 from 150, they are left with 75,000. So within 2.5 years, because they tried to pull from their account during the bear market, their $300,000 dwindled down to 75,000. And that 75,000 would have to 4x just to get back to the starting amount of 300K. They would not survive that. That's why people generally, you hear these calculations and retirement calculations, how people go back to work. You're seeing why that happens. If you pull too much from your account during a bear market and you don't have a savings, you don't have an emergency fund, you didn't plan for bear markets, you have to plan for worst case. I teach every member that. We plan for the worst. We hope and anticipate the best. You always plan for the worst. Don't plan for best case scenario, because that's how you screw yourself up. And you end up in these situations where you don't survive a bear market because you never plan for one. Now, I told this person, you need to grow it way past 300. Probably close to 1 million, but they weren't trying to hear that. Again, when you hate your job, you want to leave your job ASAP. Here's why I was trying to convince that person to grow it to a bigger amount. Because there's 2 different ways to handle pulling from your portfolio during a bear market. Scenario number 1, I already talked about it. Live off your emergency fund or your savings. Don't interrupt your account. Don't pull any money from it. Just allow your account to get back to where it was, right? You have to grow it back to the starting amount. Scenario number 2 is to grow it so it's so big that even if you're pulling from it during a bear market, you still can survive that bear market and still are left with enough money to start over with. And that's what I'll show you here. Because that same situation I just walked you through, but starting with 1 million, more than you need, 3.5 times more than you need to live off of, right? It's a buffer. This is what I did in my account. We didn't quit my job once I had just enough to live off of. I was so freaking paranoid. I've been bankrupt before in real estate. I'm like, nope, we're going to wait. We're going to have way more money than we need in our account before I quit my job. And that's what I did. And here's why. That same situation, starting with 1 million, still losing the same 25% during the decline, still pulling 75K a year. When it was all said and done, same situation, but you started with 1 million versus 300K. When it was all said and done, you would be left with $525,000, still more than you need. So you're left with a buffer to recover from that. And so that's the danger of pulling from your portfolio during a bear market. So I don't suggest people do it. And if you don't have an emergency fund, then you shouldn't be trading options in the first place. You probably shouldn't be investing. And that's a very unpopular opinion. It offends a lot of people. It offended me when I first heard it because I was like broke, living off credit cards when I learned options, right? But here's what I learned going bankrupt. Here's what I learned from studying wealthy people. If you try to get rich or build wealth without getting the basics right, the basics are like getting out of consumer debt, credit card debt, car payments. You shouldn't have any of that debt anyway, and building up an emergency fund. Then you focus on investing. Or you can do them at the same time, right? Have a debt repayment plan in action, slowly build an emergency fund, and then put a little bit of money towards building wealth. So you can tackle all three at the same time. But what happens is if people skip the sequencing, steps 1 and 2, getting out of consumer debt, saving money in emergency fund, and then you try to jump to building wealth, the universe, life will smack you around. Did it to me, right? It's like, no, you skipped a few steps, right? You tried to run before you can walk, right? Nope, go back to start over, right? You have to start all over. That's what I've seen. But the people who get the sequencing of the steps right, they get out of consumer debt, they build an emergency fund, and then they focus on investing, they tend to build wealth and keep the wealth, right? So that's what I've seen, right? People, it's just the natural laws of building wealth. It's just how it works. I have not found a person build and keep their wealth when they get the steps wrong. People who are in massive consumer debt, no emergency fund, something about the way they think and the way they handle money, it eventually catches up with them. They might make a lot of money, but somewhere along the line, like me, I was a real estate investor for, gosh, I don't know how many years, a good 5-6 years maybe, you know, a real estate millionaire, but I eventually lost it because I got the steps wrong. I didn't have the emergency fund, right? I didn't care about getting out of debt. I was like, as long as I can pay my debt payments, I'm good. Yeah, that works until it doesn't work. So anyway, that's my long-winded scenario, and I'm going to end this video now because it's already longer than I wanted it to be. Take care. See you in the next video. Bye-bye.